Uh, Welcome back. Ready to dive back into these accounting problems? We left off looking at the trade payables and receivables questions. Do you want to go through them one by one, step by step, or is there a specific spot where you're... Let's jump into problem 4.7. We're looking at a trade payables account that needs to be balanced off. So, we have this T account. Trade payables are a liability, meaning the normal balance is on the credit side. That's money we owe to suppliers. First, let's grab the numbers from the right side. We have the opening balance of $250,225 and the new purchases of $325,010. If we add those up, what do we get for the total on the credit side? You're super close on the number, but let's double check that label. We take that credit total of $575,235 and subtract the $100,750 from the debit side. That's the cash we paid out. The number is definitely $474,485. But here's the trick. Since the credit side is way bigger than the debit side, this is a credit balance. In accounting, the balance is named after the side that is heavier. Since we owe more than we paid, it's still a credit. Does that make sense why it's not a debit? Spot on. That's exactly right. You might physically write the balance C/D on the debit side just to make the columns equal. But the balance itself is a credit balance because the credit side had the most weight. Think of it like a seesaw. The credit side is heavier by $474,485. So, looking at the options in your notes, which one do you think matches now? Bingo! It is definitely C. All right, moving down to 4.8. This one is about trade receivables. That's money customers owe us. Before we use the formula, we need to fix one number. The $85,000 includes $5,000 from cash sales. We only care about the money that actually came from people who owed us on credit. So if we take out those cash sales, how much cash did we actually get from our credit customers? Wait, let's take another look at that math. We start with the total money in the door, which is $85,000. If we have $85,000 and we take away $5,000 for those quick cash sales, what's left over for the credit? Exactly, $80,000. That's the cash that actually reduced what people owed us. Now, we use the main formula. Think of it like a bucket. You start with $10,000, you add new sales, you take out the cash received, and you're left with $9,000. We got the $10,000 from the Jan 1st opening balance, and the $9,000 from the DC 31st closing balance. So, if we solve for S, which is our credit sales, what do we get? Almost. Let's walk through the algebra slowly. We want to get that sales number S by itself. If we move the $80,000 over to the other side, we have to add it to the 9,000. That gives us 89,000. Then we subtract that opening 10,000. So what's 89,000 minus 10,000? 0.9. About the double entry? That's a great question. Think of the receivables account like a list of people who owe you money. Credit sale, the debt goes up. You add it. But when a customer gives you cash, they don't owe you that money anymore, right? So we subtract the 80,000 in receipts because that's debt that was canceled out by cash. And for the opening and closing balances, we start with 10,000. We want to find out what happened in the middle to end up at 9,000. If we just added everything, we'd be saying everyone owes us more and more forever. Does that help clear up why the cash is a minus? Not quite. Let's clear that up, because it's a super common point of confusion. The 85,000 is just the total amount of paper money that hit your hand during the year. 5,000 of that was from people walking in, buying something, and paying right then. That's why we strip it out. It has nothing to do with the credit balance. The other 80,000 came from customers who were already on your IOU list. When they paid that 80,000, their debt to you went down. Does that make the difference between the immediate cash sales and the credit payments a bit clearer? Actually, there is still some debt left. That is what the $9,000 represents. The problem tells us that at the end of the year, on December 31st, the trade receivables balance was $9,000. So, even though they paid us $80,000 during the year, there are still some customers who haven't finished paying yet, and they still owe us that final $9,000. Does it make sense now how we started with 10, added 79, took away 80? All right, let's roll into 4.9. This one is a classic double entry puzzle. A business sells $100 worth of goods to a customer. Now, here's the kicker. The question asks for the entry in the customer's records. So we are looking at this from the perspective of the person buying the stuff. When we buy goods for the business, we use the purchases account. Since we are getting more goods, do you think we should debit or credit the purchases account for the full $100? Close. Well, let's look at the rule for expenses and assets. When we get something of value or incur an expense, we debit it. Since purchases is like an expense account for the inventory coming in, we debit purchases. Now, for the other side, we are losing $50 in cash. Cash is an asset. So if it's going down, should we debit or credit the cash account? Spot on. We credit cash because it's an asset leaving the building. And what about that final $50? We still owe it to the supplier. That's a liability called payables. If our liabilities are going up because we owe more money, do we debit or credit that payables account? Check the table I wrote on the right. You got it. increase in liabilities is a credit. This matches the third option in your notes perfectly. One big debit for the total value, and two smaller credits for how we paid for it. How are you feeling about these three problems now? I totally see why you're thinking that. It's because the first sentence says a business sells. But look really closely at the question at the end. It asks for the entry in the customer's accounting records. If I sell you a burger, I record a sale. But you record a purchase. In accounting exams, they love to swap the perspective like this. Since we are recording for the person who received the goods, we have to treat it as a purchase. If we were the seller, you'd be right. It would be a credit to sales. But as the customer, it's a debit to purchases. Does that sneaky perspective switch make sense now? Most of the time you're right. Usually we are the business, but every now and then they'll throw a curveball and ask you to sit in the other chair. It's a classic trap. If you see customers' accounting records, just imagine you're the one walking into the store with your wallet out. Ready for a quick summary and those flashcards we talked about to wrap this up? You got it. Let's pull it all together so you have a clean reference. For 4.7, we just balanced the T account. We added up the credit side and subtracted the only debit entry we had. In 4.8, the big step was stripping out those cash sales of $5,000 to find that only $80,000 came from our actual debtors. And for 4.9, the key was the perspective switch. Since we were the customer, it was a purchase for us, not a sale. There you go. Everything is laid out. Feeling like an accounting pro yet? Great question. The examiners always leave clues. You just have to hunt for them. Basically, if you see a name or a role like customer or supplier, underline it immediately. That's your compass for the whole question. And if they give you a total number like 85,000, always look for the word including. There's usually something hiding in there that needs to be taken out. Does that give you a better strategy for the next time you see it? Boom! Glad